All right, listen, it's 101. Good to see everybody. Happy Wednesday. We've got a really cool workshop planned for you today. We're getting towards the end of 2023, and we're going to get into some tax strategies, some tax planning with my personal CPA. He's also the CPA of many of you inside of this coaching program. Mr. Joe Angel is going to help walk us through some of this stuff. So first and foremost, Joe, thanks for doing this again. We appreciate it.
Yeah, of course. Good to see everybody.
For sure. So here's how the workshop's going to go today. Joe and I are going to spend probably 15, 20 minutes going through number one, business entity setup. So are you set up correctly? Number two, we're going to go through what I call the flow of money. So when you get a commission check, we're going to talk about what needs to happen with those funds. And then number three, we'll talk about some tax planning, some tax strategy. And then we'll have plenty of time for some Q&A because we've got 45 minutes with Joe. We'll take the first 15 or 20, and then you guys can have the rest to ask Joe any questions that you want. Now, Joe, before we get started, you can help real estate agents in pretty much all 50 states. And so how can they get a hold of you if they want to strategize from a tax perspective with you?
Yeah, perfect. The best way is to call my office at 248-649-8720 and ask for Annie. She's my assistant. And then Annie then will schedule a introductory conference call with you guys. I put the number in there too. What I like to offer to Brandon and his students is a complimentary consultation. So the best thing, set me your last year's tax returns. I'll review those, go over those thoroughly, and then I'll talk about my findings there. And more importantly, what you can do differently. Also, there's some times where the misses are so bad that you can go back and amend these returns and get some money back that way. But that's the best way. Like Brandon said, I'm licensed in all 50 states. I specialize in realtors. I currently have realtors in 43 out of 50 states. Real quick here, my team, about 25 people that work for me now, a bunch of CPAs. We have certified QuickBooks Pros, so we do bookkeeping. I have paralegals in-house where we do these entity setups, LLCs, S corporations, payroll, audit, sales tax department. Really the bulk of my business, it's year-end tax work. We go through some really good deduction checklists, make sure that you're maximizing your write-offs, and then, setting up quarterlies, adjusting quarterlies, doing tax projections, all that good stuff. So
awesome.
That's our deal. Yep.
Cool. So when we get into this, you guys, Joe has helped me for a long time and many of you too. And this is like a huge deal, especially for us being real estate agents, not knowing what we don't know. You're going to learn a lot. You're going to learn a lot. So let's jump into it. Let's talk about entity setup. So before we get into this, Ben, I want to do a small little poll in the group. There's about 100 or so people here right now. How many of you right now are set up either as an LLC or an S Corp? Simple yes or no. Ben, if you could throw that poll up really quick, I'm curious to see where everybody lands with that. So yes or no. And I want to see kind of where we're at. Did you throw that up?
Yep.
Okay, I don't see it. You probably see it.
I saw it on my end.
Okay.
We got about 50%. So let's just hammer that out, everybody, real fast.
Cool. So we'll just leave it at that's okay. So what are the results of that, Ben? I'm just curious.
Yeah. So far it's 50-50 on setup as an LLC. And it is about 30-60 on the bank account commission.
Okay.
Getting closer to 50-50.
Got it.
They probably mirror each other pretty well.
All right. So let's talk about business entity setup, Joe. So when you work with a real estate agent, I know there's a couple things to look at. First off, let's talk about being set up as an entity, and then you could talk about the difference between S Corp or S selection.
Yeah, I like it for realtors right off the get-go. Set up a business entity. We usually start with an LLC. You get your brand, your team name, business bank account, commissions going in there, paying the business write-offs from that business account. Really get used to running your life like a business, like we talked about before, Brandon. So you start off and you set up that LLC. Okay, that's easy, no brainer. Now it's, should I be in an LLC or an S corporation? I hear all kinds of different things. My rule of thumb for any business, not just realtors, as soon as that gross number, so for you guys, your GCI, your gross commission income, as soon as that number is at 150,000, the S corporation makes sense. Okay. The nice thing with setting up an LLC early on is at any point you can S-elect that LLC so it's treated as an S corporation for tax purposes. So same name, same tax ID, same business bank account. It's just being taxed as an S corporation. And you can actually do that. Let's say right now, today, you have an LLC. You can S-elect that LLC all the way up until March 15th, 2024, and it'll still go retro for the entire 2023 tax year. So if you think you're getting close to that 150 number, you have an LLC, we can S-elect it. If you think you're getting close to that 150 number and you don't have an entity, we can still create an S corporation now, and that will also go retro for the entire 2023 tax year. What you can't do, you can't get into tax season, January, February of 2024, and say, oh, shoot, look, my commissions were 200 grand. I need to set up an S corporation. You can't do it then. It won't go retro for 2023. To set up a new S corp, it has to be done in 2023. But that existing LLC, to S-elect it, you have until March 15th, 2024.
Got it. And so can you just kind of walk through the advantages of that setting up as an S corp?
Sure. Huge tax savings. So you guys are taxed on a net number. You have your gross commission income minus all your business write-offs equals a net number. Bottom line, that net number in an S corporation is not subject to self-employment tax or SE tax, which is 15.3%. For a lot of your students, when I review their tax returns and they just filed as a Schedule C and they had good gross, they're getting hammered on self-employment tax.
Yep.
If you look at that line item, it's probably a bulk of what you're paying in taxes. So you might say, okay, well, what about Social Security? I still want to pay into that. The number one rule with an S corporation, if you go that route, is you, the officer, you have to be on a salary or a W-2 wage. That wage, the IRS calls it a reasonable compensation. So we just issue something on wages and you pay into Social Security there. For a lot of the realtors that I work with, I don't feel like dealing with payroll. I'm not hiring ADP and paying. I don't even know how much I need to pay myself. We'll step in now, run a tax projection, see where you're at, come up with that W-2 amount. We can issue it on paper. You pay the payroll taxes on it. Then that gross W-2 amount and payroll taxes also becomes a write-off to your S corporation, bringing down your net number. Then you're not guessing. For example, 150,000 gross, right, Brandon? Minus 50,000 in expenses leaves you a bottom line of 100. We look at it and we'll say, okay, a reasonable wage, maybe 30 grand. We issue that wage on paper. You pay the payroll taxes. So that's the only thing that affects your cash flow. That wage amount and the payroll tax also becomes a write-off to the S corp, bringing down your number. You're not paying less tax because the net number's lower. And you're still paying into Social Security. You're just not overpaying like you would if you don't set up an S corporation.
Love it.
Any business over 150,000 gross, if you're not filing as an S corporation, you're leaving a ton of tax dollars on the table. So
love the explanation and trying to keep it simple. As we go through this, you guys might say, man, I just still don't get it. That's why Joe started off to say him and his team can do all of this for you. They can do a consultation to see what your tax liability is and what it could be. And so what he just said was on $100,000, typically realtors are leaving somewhere, would you say 15.6%?
15.3. So that SE tax, 15% off that bottom line of 100, that's 15 G's. Just by going into an S corporation, you're saving that amount in taxes.
It's insane. I mean, that's just one thing. All right.
Okay.
So again, we're going to come back and do a full Q&A. So write down all of your questions, okay? So takeaway number one, it doesn't matter if you're brand new, you've been in this business for 47 years, it does not matter. We set up as a business entity from day one. There's no downside to that. Number two, let's talk about what I call, Joe, the flow of money. So Agent Bob is set up with his entity. Now he gets this commission check from his brokerage. Walk us through how the flow of money should happen, what he should do with that commission check.
Sure. Ideally, the broker can issue it to the entity's name. That's ideal. If not, we'll talk about what to do in a second. Ideally, it's issued to the entity name. It's put into your business bank account. I then go over with you all these different business write-offs that should be paid from the business bank account. Your auto, your cell phone, meals, travel, home internet, insurance, advertising. And I have a really good checklist of all these expenses. So the money goes in, you pay all these business write-offs first. Whatever's left over or whatever you need to pay personal expenses, you transfer that money from the business bank account to your personal account and you pay your personal expenses. For realtors, really the only thing that should be paid personally, mortgage, real estate taxes, different things like that. The majority of your lifestyle, the majority of your meals, your travel, your gas, your cell phone, those should be paid out of the business bank account because those are business write-offs. You're in a unique industry where you can justify your entire lifestyle as a business write-off. Simplify things. You open up that business bank account, get one credit card, one debit card linked to it, and just slam all those expenses on there. Okay. The nice thing too, a lot of those cards, at the end of the year, they'll give you a summary of all your expenses. Guess what? Your accounting's done already. Here's all my expenses. They came from this account and this credit card. Look how simple that is.
It's amazing. It's a no-brainer. And so also I think the key thing is that a lot of agents, I don't know if they struggle with it, but they get a $10,000 commission check. The understanding, the key takeaway here is that is our gross number. And I'm Joe, I'm talking to the people now, right? So this is our gross number. This is what we spent a lot of time on a couple weeks ago, Ben. Joe, this is why we wanted to have you on today. People were really confused because the gross number is not our money. This is the business's money that expenses come off of, that we pay ourselves from. And we're left with that net number. And so we're paying ourselves out of that business bank account as well, correct?
Absolutely. So then we talk about that. And again, all those business expenses, then the money that you need personally or that you want to put, you just draw it right out of that bank account into your personal account. Okay. Next thing that always comes up, taxes. How much should I hold for taxes? Every tax situation is different. It depends on your effective tax rate. If you guys are married, your wife or husband has W-2 income, that all combines, that rate might be higher. My rule of thumb, save about 20% of that for taxes. And on the taxes, you should and need to pay those taxes on a quarterly basis. Right now, for a lot of my new realtors that are reaching out, oh, shoot, I didn't know that, Joe. So right now we're running tax projections. Okay, let's see where you stand. Yeah, one, this is a no-brainer. Let's set up an S corporation. Two, why haven't you paid any taxes? We set up an estimated tax voucher, pay in some taxes now, and then we really plan out the end of the year, talk about that W-2 amount and different things that we can do this year to save you taxes too. But again, if you're not paying your taxes quarterly, you're going to get hit with what's called an estimated underpayment of estimated tax penalty. Look, you guys, we already give them enough money. If you have this money sitting in an account, Pay that money in quarterly to avoid those penalties. 5, 7 years ago, the IRS in the States, you could get out of those penalties. Right now, super, super hard. They might give you like a one-time waiver, and that's it. That's how they make their money. So you need to pay those taxes in quarterly. So on Brandon's original point, the gross money comes in. You pay off all your business expenses. Okay. 20%, I'm talking 20% of that gross number needs to be saved for taxes. Then whatever's left over, shift it over to your personal account, pay all your personal expenses.
Yep.
We talk about W-2 and wages. Why I don't, unless you have employees, and some of you guys have teams and employees, I don't like the payroll on a weekly or monthly basis, because as a realtor, you really don't know what your income is going to look like. So forget that. Pay yourself personally, take it out of the account. We step in at the end of the year, we issue a wage that way. Then we know the amount. Then you're not guessing. And like I said, too, you're not paying some payroll processor $100, $200 a month to process this payroll. We can issue it at the end of the year.
Yeah, I love it. So, question for you, Joe. When we build the business plan for all of the agents here in our coaching program, we build into the business plan 30% for taxes off our gross number. So you would say that's more than safe.
30 is good, probably conservative.
Good.
Especially if you're going the S corporation route. Look, at the end of the day, 30%, I'm not going to fight with Brandon's program. Look, at the end of the day, you have a little extra money in your savings account. Keep saving that, accumulate that, take a vacation. Truthfully, though, if you dial this in properly with write-offs and an S corporation, that number's probably 20%. But I like 30. I'd rather have more than less.
That's exactly right.
Yeah, again, don't let it just sit there and pay your taxes once a year. You're supposed to be paying in quarterly. Send both the IRS and, if it applies to your state, quarterly tax payments. And like I said, right now, Brandon, we probably got about 40 of them that we're working on. We're working on year-end tax projections right now. So, okay, let's see where you stand. Does the S corporation make sense? Oh, you haven't paid any quarterlies? Send it in now. That'll get rid of a lot of those penalties if you've missed it thus far. And we can plan out the next 2 months of the year. There's certain things in the current tax code that are changing next year that are dropping off. We'll probably talk about that a little bit later. But that's the plan. Like, oh, shoot, I made all this money. I haven't sent in quarterlies. Don't just wing it. Don't overpay them. It's your money. Let's get a tax projection done, see where you're at. Then we can set up the quarterlies for you.
Cool. So
just
guys,
so people know the dates, you want to hit those, Joe?
Yeah. So April 15th, June 15th, September 15th, and then January 15th of the following year. Those are the 4 quarters when quarterly tax payments are due.
Got it. So I know you guys have a lot of questions. Again, we're going to open this up for Q&A in about 5 or 10 more minutes, I promise. So just hang tight for a minute. I see some stuff coming into the chat. We're going to open it right up, and Joe will answer all of this personally for you guys. All right. So let's actually do that. Let's move into tax strategy. Let's talk about some write-off opportunities. And we've got a great checklist that Joe's given us for years and years and years. We'll get an updated one from his team. We will post that in our Facebook group, okay? So we're not going to go through 777 things that you can write off, but let's just talk about any tax planning or tax strategies that you're seeing this year, Joe, that might be changing in 2024.
Sure. Couple hot topics. So 179 depreciation on vehicles. So this is a vehicle that you buy. It has to have a gross vehicle weight of over 6,000 pounds. Most SUVs qualify. So you buy this, new or used. You can finance the entire thing. You don't have to come out of pocket $1. Currently, in 2023, 80% of that purchase price is a write-off.
Wow.
If you remember, last year it was 100%. In 2024, it drops down to 60%. You're seeing a lot of Trump's tax reform come to an end. And that's a big one right there. So you're looking at an SUV, it's over 6,000 pounds. You buy it, new or used. You finance it. You don't come out of pocket $1. You get 80% of that purchase price as a write-off right now in year run. That's a significant tax break.
If you
Massive.
squeeze it in before the end of the year, is it 100%?
Nope, that was in 2022.
Sure.
So for 2023, you only get 80% of that purchase price. And all you need is you need a VIN number by December 31st, 2023. You don't actually have to have the vehicle in your possession. Most of these dealers know these rules, some don't, but that's huge. 80, buy a $100,000 vehicle, 80 grand is a write-off. Write off your gross commission. For you guys at a 30% tax savings, do the math. $80,000 write-off, that's $24,000 in tax savings.
Wow.
That's huge. Yep. And that's coming into an end. Next year, it's only 60%.
Got it. Any other big ones that you're seeing when you work with a new client to say we're missing the boat? I know you've already talked about a couple. Is there any other ones that you feel like real estate agents really miss the boat on that you guys can help with?
There's a lot. And again, like I said, in your industry, so much you can justify as a write-off. You're traveling with your husband, with your wife. You're looking at rentals. You're looking at real estate. You're on that trip. You can write that off. Plane, hotel, travel meals. I see a lot of the home office stuff missed. I don't like the home office form. We've talked about that before. I think that's a red flag. What we do is we'll take a percentage of all of those utilities, write that off through the business. Typically 100% of that home internet. Look, you're at home, you're working, you're doing stuff within the home office, computers, iPads, desk, TVs, shelving, painting, all that stuff, 100% deductible. That can all be written off.
It's incredible. So
can we touch on retirement accounts for a little bit?
Yeah, qualified retirement accounts. For you guys, these are no-brainers. If you're in a non-S corporation, a SEP plan makes sense. In an S corporation, it's a solo 401k. Both those have very similar rules. The solo 401k makes sense for the S corporation because that's considered non-earned income. And what you can do, you can defer $22,500 out of your W-2. And if you're over 50, you can do the catch up of 7,500, so 30 grand. And when I say defer out of your W-2, we set up the S corp, we look at that reasonable compensation. Okay, 30 grand makes sense. You can take 22.5 and defer it right over into a solo 401k off that W-2. Okay, those SEP contributions and solo 401k contributions, those act as a business write-off. So again, 30%, you put 20 grand over into a solo 401k, you just saved 6 grand in taxes. No brainer. It's your money, right? You're taking it from this savings account over here, and you just created tax savings by doing so.
That saved me massively. I mean,
Yep.
that whole piece, Joe and our financial planner work closely together, which again, I don't want to put words in your mouth, Joe, but I would imagine you're happy to strategize with everyone's financial planners to make sure we're right hand, left hand on what's being done from a tax planning perspective. Is that right?
Absolutely. Your attorney, your financial planner, conference call, that works best. I don't sell financial products. I know some CPAs do. We're not in that. We're strictly focused on tax saving, and that kind of stuff. A lot of times I know a lot about those plans, sometimes more than a financial planner. So I can definitely help work with your financial planner and guide you. But as you guys start growing and you're making more and more money, you're, like I said, a business owner. So guess what? You're responsible for your retirement. You don't have a pension. You don't have stuff like this. You have to take advantage of this stuff and plan your life out. And by doing so, you're saving tax dollars. So if you got the money, send some money over there. There's some tax savings. Keep in mind too, you're like, well, the stock market, it's weird. 2024 is coming. I don't know. You can put money in these accounts. You don't have to invest it in the market. It can sit over in cash, over in savings, and you still get the write-off. Keep that in mind.
So here's what we're gonna do. We're gonna change gears. We're gonna get into some open Q&A. I see a lot of things happening in the chat. I'll just tell you guys again, when we talk about wealth creation, we talk about being a successful entrepreneur. I've talked about this for years, to have a team to help you manage your finances the same way you guys are part of your clients' financial teams, right? So I used to meet with Joe all the time. I was probably pretty annoying as a new client, but I had to meet with him just to understand the strategy, understand what we're doing. I see a lot of you saying, man, my CPA doesn't say anything like this, doesn't talk about any of this stuff. This is why it's important to have a financial planner, to have a CPA, to have an attorney, having a financial team that surrounds you in your business to ensure that you're set up the right way, that you're not overpaying in taxes, that you have little liability or risk. And so anyway, Joe, why don't we open up for some Q&A? The way we're going to do this, you guys, is exactly what you guys are doing. Raising your yellow Zoom hand, and we'll get through as many as possible. Ben, if you can handle getting people unmuted, and then you guys can ask away. Raymond, we can start with you first.
Well, I'll just go in order.
Yeah.
I'm seeing him on the list.
Oh, whoops, I'm sorry.
That's
Musa.
all good. Moose's first.
Yeah. Hey, Joe, can you guys hear me?
Yep.
Yeah.
Thank you for being on, first of all. And Joe, I run into this quite often. I don't know how much business you do currently in Massachusetts, or if you're familiar with Mass.
Yep.
But I've had this conversation with my CPA regarding this subject. I wanted to proactively set up a corporation in order to just start, getting into the good habits, like you had been mentioning. And apparently here in Massachusetts, the entity that you create, I don't know if it's Massachusetts real estate license law, they can only pay, so if I do set up an S Corp or an LLC, I believe they can only pay another licensed brokerage or something to that effect. I keep getting different thought processes. There is another individual that is at my brokerage who has an S Corp that's not licensed as a brokerage, and the brokerage is paying his S Corp directly. Like they'll issue a check to his S Corp. So I just don't know what the thought process is around that.
Super common question. I'm in the state of Michigan, like Brandon, and our rule here is to get paid as an S corporation, you need your broker's license. Okay. However, two things that I can explain based on your questions. One, the rule about having your broker's license is a state rule, not an IRS rule. Okay. I've been doing this 20 years. My father, who started this firm, he's been doing it 42 years. We've never seen an issue with a realtor and the IRS filing an S corporation who didn't have their broker's license. That being said, Brandon knows what I'm going to say. If that's the rule, go get your broker's license. The test isn't too bad. However, you won't have an issue with the IRS.
Let me
go ahead.
Can I just add something from a broker's perspective? So Musa, we have the same rule in Michigan. We share that. What Joe just said is exactly how we handle that with all of our agents. So we issue them their commission check. We issue it to them personally, and they have no issue taking that check that we issue to them personally, and then they take that check and put it into the business bank account.
Okay.
Yep, that's that. And then secondly, so that's it. You get it, business bank account, do everything that I talked about, go through my checklist. Secondly, then you're going to get a 1099 that's going to come to your social, not to your tax ID of the S corporation. So you take that 1099 on your personal return. You say, hey, IRS, this was actually reported on tax ID, blah, blah, blah. Kick it over and report it on your S corporation. That's the easiest way to do that. Silly rule. Some states have it, some states don't. But there's definitely easy way around it. And if you're grossing over 150, like I said, not doing the S corporation, the couple extra steps is way worth the tax savings. And again, not an issue with the IRS. This is a state rule. If you really want to sleep well at night, go get that broker's license. You don't have to worry about it, but not an issue with the IRS.
Yeah, makes sense. And this is when I do get that 1099. This is something my CPA, or a CPA can take care of, right?
Yeah, easy.
I don't
Like
want
I
to put
said,
I don't want to put any thought process into this.
yeah, no, it's simple. Hey, this is all going to be reported under my S corporation. There's an actual line item on the personal tax return where you can shift 1099 stuff over into a tax ID. So it's actually put on the return for that purpose.
Okay. Makes sense. Thank you.
Yep.
All right, we'll go to Susan.
So, okay, with real estate, I get it, LLC or S Corp if you're 150, but what about the back end of like having rental properties and putting them into an LLC and operating like a business? Like, are you guys expert in handling that whole thing and also personal property, like my primary residence as a trust, as like, into a trust or setting that up into like another LLC? Like, do you guys handle that whole projection when you have like multiple properties and
Yeah, we
operating
do.
a business?
So realtors, mortgage professionals, and real estate investing. That's our sweet spot. On the
Okay.
rentals, what I
Yeah.
like, if you have multiple rentals
Yeah.
and they're owned by the same players, the same people
Yeah.
are involved, you and your spouse, right?
Right.
You open up one LLC as a holding company. Okay.
Okay.
Each piece of real estate is then put in its separate LLC. Each piece of real estate in
Right.
its separate LLC, but it all flows into one nice LLC that's a holding company.
Mm-hmm.
Now you have one nice, neat business tax return, and all these LLCs are reported underneath that. Number one, putting the rentals in its own LLC from a liability standpoint, you've
Right.
not protected yourself, right? Someone can't slip, fall, sue
Right.
you or your other assets. Okay. I will mention that if you have mortgages on these properties, each lender has different rules. Some lenders, if you were to quit claim the real estate out of your personal title to the LLC, it will force a refinance. And where rates are, we don't want to do that. Some lenders don't have that rule. So before you do anything, check with the lender. But from a tax standpoint, whether you quit claim the title or not, we can still report all of that in the structure that I advised you on.
Yeah, because I don't like my name to be on any properties that I have. Like
Makes
I like,
sense.
yeah, because the way, you just operate and do business for protection.
Yep. And the nice thing too with the holding company structure, Susan, is then when you open up a bank account, you have the bank account that's a holding company. Each LLC has like a separate account within there, but it's really one business bank account. So now you can really manage your money and make transfers. You're not just collecting all these checks personally.
Yeah. I have it individually and it's auto set, paying mortgage and dropping the the tenants like paying and stuff like that. I have it all separate. Like I just don't have it all into one account. But so that would be interesting to see how that would look like.
Yeah, you open up the LLC for each piece of real estate, ultimately quit claim the title into that LLC. But again, from a tax perspective, if you can't do that, we can still file that way. On the real estate investing side, have you guys heard of cost segregation?
No.
Okay. So cost segregation really makes sense for rentals. What it is an engineer will come in. So normally you depreciate a rental over 27 and a half years. They come in and they segregate the costs, the roof, the doorknobs, the windows, the doors, the floors. Now, instead of over 27 and a half years, you get a bunch of upfront bonus depreciation based on the cost segregation. And for real estate professionals, you get to take rental losses. So you have this rental out there, you're depreciating over 27 years. You get cost segregation done on it. Now you have all this front loaded depreciation that you get in year 1, year 2, year 3. A lot of times it's such a big number, you're not paying any taxes at all. Okay.
Mm,
And my firm, I work with a national cost segregation group. The cool thing with them, because we do so many deals with them,
mhm.
they'll analyze your situation for free. You give them your address, the purchase price. They'll say, hey, Susan, this property, you're going to get 100 grand of depreciation in year one. And here's our fee. The reason why it didn't used to make sense for rentals, their fees were way higher. It only made sense for like commercial buildings and apartments. Now, literally, if you have one rental property, it makes sense because their fees are minimal and the tax savings are tremendous. Cost segregation is a very hot topic right now with people who own rentals.
And Joe, correct me if I'm wrong, but if you don't need it all this year, it can carry over.
That's right. You can decide based on the cost segregation report how
Mhm.
much you want to use. Do you want to take the rest over life? Or, hey, we're going to take all the depreciation. Now it's going to create what's called a net operating loss or
Mhm.
an NOL. That NOL carries forward to future years. Like I said, if executed properly with a cost seg, there's probably 2, 3 years where you're paying no taxes at all. Where a cost segregation does not make sense is if you're going to flip this house or if you're going to sell it in a couple years. Because
Mm.
depreciation on any asset, a vehicle, a rental, a computer, depreciation is a borrowed expense. Meaning, when you sell the asset, you have to recapture the depreciation. You have to pay tax on that benefit that you got. But if this is something like you're building a portfolio and you're going
That's
to have,
correct.
yeah,
Yeah,
it's
that's
a
what I
no
wanted. So
brainer.
I don't mind paying taxes as long as I have like the 20, rule of thumb, like when you're qualifying, when you have these assets, and then you have, we're putting 20% off in accumulating because we understand that there is that appreciation over time. But if we're accumulating to then offset moving forward, then that's for me, that's my way of like thinking of my future retirement.
Yeah, no, I like it.
Yeah,
Cost sag, and again, Brandon, if they reach out to me, if it's just for this piece, I can hook them up with that national group. They'll give you a free analysis,
amazing.
which is nice.
Okay,
That'd be
Yeah,
great, Joe. Thank you.
I appreciate it. Thank
Thanks,
you.
Susan. All right, let's go. We got Joe for about 10, 12 more minutes. So let's make sure we get through as many as we can. Nikita, we're going to come to you.
Awesome. Hey Joe, can you hear me?
I can.
Awesome. Yeah, thanks for coming on. I'll be as quick as I can. So, going on my second year in the business, kind of had to learn. Never really had a good CPA, to be honest. Kind of figured out how to do things alone. So I have a business bank account, personal business bank account for taxes, all that. I did all that myself, but never made an LLC. So like, I guess I'm a sole proprietorship. And I want to do my taxes right from now on and just know everything correctly. So pretty much just, um, LLCs, I was told not to get it by this one CPA I had last year because they're like, oh, it's 800 a year and it doesn't really do anything for you. And I was just like, okay. So I took their advice, which I now see was wrong completely. So I guess, what, like if I got an LLC, what does it do as far as like, does it just protect me as a business owner, or does it actually help with some tax stuff like an S corp, or is it completely different? I mean, obviously different from an S corp, but
Yeah, great question. So if you don't get an LLC, you're filing as a Schedule C on your personal tax return. The LLC would also be filed there. No tax benefit from an LLC. Same tax situation. The S corp is where there's a different tax benefit. But the LLC, one, you get used to having that business bank account, running it like a business. Two, the fact that you can select that LLC late is always nice. Where if you don't open up an LLC and you tried to open up an S corporation, let's say in January, like I said, of 2024, that won't go retro. If you have that LLC, you can select it, like I said, all the way up until March 15th, 2024, and it'll go retro for the 2023 tax year. But to your
okay.
point, no tax savings. So that gross commission minus expenses equals a net number. the net number is still subject to self-employment tax in an LLC. It's the S corporation where it's not.
Awesome. Yeah, that's so much clearer. Thank you. And then I have a retirement account. I started when I was 25, a couple of years ago. It's just a regular Roth IRA in M1 Finance, and I've been just contributing to it like obviously every month. But is that still okay to have currently, or like is SEP IRA? Do I have to like go into that? I've never heard of. My broker talked about it once, but very briefly. I just don't understand it. Is it the same thing as like a traditional IRA, or is it just for realtors? Or
So for you guys,
Yeah.
anybody who has self-employed income, whether it's LLC or S corporation or non-LLC, if you ask me, number one, contribute to a qualified account, either a SEP or a solo 401k, because the tax savings are so much greater. When you contribute to a Roth, there's no tax benefits. Now, when you pull that money from a Roth, you get to take that money without paying taxes. The IRA, a traditional IRA, there are some tax benefits, not as great as a SEP or a solo 401k. For you guys, again, non-S corps, LLCs or Schedule Cs, a SEP plan, SEP. For S corporation, a solo 401k. You're going to get roughly a 30% benefit. By 10 grand into a SEP, saves you 3 grand in taxes. You're getting no benefit from a Roth and minimal benefit from an IRA. So if you ask me, max out those accounts first. Now you have the Roth going, you can still have that over there. I would get a SEP plan going so you can maximize the tax benefits.
Cool. Tucker, go ahead.
Hey, I got two quick questions here. I guess the first question would be like I'm a brand new agent in this. I just closed like my first deal this morning.
Congrats.
So I guess my first question would be like, at what point does it make sense to start working with someone like you?
Honestly, working with me from the very beginning, okay, you don't get so a lot of Brandon students right from the get-go, even if it's just filing 23's tax return, take advantage of those write-offs, and then we can get you set up right moving forward. And my fees, I think my fees are fair. Whether you're $1 million guy or a $1 guy, it's all about my time. If you give me the information and it's clean and it's easy, then the fees reflect that.
Awesome. I guess the second question with that, I know you said like your specialty is in like pretty niched into real estate. I guess, I have a rental portfolio. I have some other investment vehicles as well. Like I have a ownership stake in about 10 oil wells for like intangible drilling costs and things like that. If I were to work with you, are you familiar with other investment vehicles and how the deductions and those kinds of things work outside of that?
Yeah, real estate,
too.
realtors, more, that's my sweet spot because I work with so many of those. But really, it's small to medium-sized businesses and the owners of those businesses, right, planning you out. But all those different investment opportunities and situations that you have, I've been doing this 20 years. It's weird to say, but I've seen a lot in the 20 years and can help you with all that.
Can I set up a call with you after this? I don't know if Brandon's like sharing the information or anything afterwards, but I'd like to go ahead and get a consultation set up.
Yeah, for sure. So my
I'll
number
repost.
and then my assistant and then a nice introductory call. And then anybody who's on this today, a free consultation, send me over a copy of last year's tax returns, give you a look at it, make my recommendations, and then we can move from that point.
Yeah, Tucker, there's no downside. I started with Joe right from the get-go, right from the get-go. And so have a conversation with him. He'll get you on the right path.
All right.
Another thing
Sounds
too,
great. Thanks,
some of
guys.
these other CPAs, like I have 25 people here. If you come in through me, I'm always still your point of contact. It's not like you come in and I hand you off. I have other CPAs that are going to prepare the returns. I review the returns, but like high level, like tax planning and consultations, that kind of stuff, I'm always in the loop. And our engagements, like texts, emails, projections. Hey, I'm looking to buy a property. That's all included. We don't bill hourly like attorneys. That's all wrapped up into one fee. Like Brandon said earlier, use me as a resource, right? You guys are out selling real estate. You're working with a great coach. Focus on that side, and me and my team can focus and help you over here on this side.
So yeah, not to continue to toot Joe's horn, but some of you guys work with him already. But yeah, that's exactly how we use Joe. Me and my wife Amy, we talk to Joe before we make any big business decisions, because I don't want to make a bad decision pen and expose myself. So yeah, that's what having a CPA is, Tucker, right? So it's not just a accountant, right? It's not just a tax guy. It's a business partner that you can lean on. So anyway, all right, let's Joe, you cool? We run like a few minutes over.
I told you I'm good. Yeah.
Okay.
Take your time.
Let's get through like three more. So we'll go Ben, and I think we missed Ramon, and then we'll end with Dan. But go ahead, Ben.
Hey, Joe.
Hey, how's it going?
Good. Hey, the way I have my stuff set up now, I have an LLC. Like Brandon said, the commission check comes in, it goes directly in, and the brokerage comes into my deal. My few questions are, do I need to adjust my quarterly tax owed yearly? And then the other one is there a minimum amount? Like I pay all my phone bills, my Vulcan, my coaching, all from my LLC. But is there a minimum amount that I need to be transferring from my LLC to my personal to say that I'm paying myself? And then one last thing, and I'll let you respond. If we decide to work together, because I'll probably do a consultation, do you monitor that and make the adjustments on an annual basis that I don't have to get in there? I can give you access to my stuff where you can have your people go in and do that, so I don't have to worry about that part of it.
Yeah, so a couple different questions you had. One, your quarterlies should be adjusted on a quarterly basis based on the quarterly revenue that you have. If you're down, send less. If you're up, you should send more. That's something that we do. We do full bookkeeping for a lot of the realtors out there. Hey, I don't want to deal with this. Access to your business bank account, access to your credit card. We're providing monthly P&Ls. The realtors love them, but more importantly, on our end, then we can adjust those quarterlies on a quarterly basis and get it dialed into the exact number. Okay. As far as a minimal paying yourself, you're an LLC, not an S corporation. So you don't have any wage requirements. So you don't have to worry about paying yourself personally anything. Anything that you pull from that account, you pull from that account. Again, the only things that you should pull from that account is those personal type expenses like your mortgage and stuff like that. Over here in the business account, hammer that with your business expenses. Take advantage of the industry that you're in. Hammer those all out of the business bank account.
Okay, great. And then only 30% of my commissions go to I have a tax holding bank account. So, and then the last thing is, would it be good now that we're in November 8th, just to set up a deal and start early in 24 with you guys?
Yeah. So two things is we can do that for sure. I'll look at what you're at. But a lot of the new realtors that have found me through YouTube or, my different programs that I work right now, they're like, shoot, I don't know where I stand, right? So we're stepping in now and we're doing a tax projection. I'd get your income, get a rough idea on your expenses. All right, here's where you're at. Let's send in some quarterlies now. We'll hit them again January 15th. And then all part of that process too, analyze your entity, really plan out the end of the year, purchases that you can make, planning that you can do now. Some of the funding of these retirement accounts, like that deferral off a W-2, that has to be deferred by 12/31/2023. Now, some of those other contributions, like a SEP or profit sharing within a solo 401k, you don't have to fund those until you file your tax return. So I have a lot of clients that have an S corporation. They file an extension that takes you to September 15th, 2024. You don't have to fund that retirement account until September 15th, 2024, but you still get the deduction in 2023. But we're really busy with tax projections right now.
Okay, perfect. Thank you very much.
Yep.
Ramon, go ahead. We can get you unmuted. I think we missed you first time. Go ahead.
Yeah, hey guys, thanks for having me. And Brendan, amazing call. Joe, thank you so much for hopping in. So I have a question. I just want to break it down like a roadmap. You know, when money is coming into S Corp, let's say it's 200 grand. I pay myself 50 grand as W-2 wage that I pay taxes on. There's still 150K left. And let's say I deduct another 50K of deductions out of it. So there's $100,000 left in S Corp account itself. What are the ways of utilizing, like how can you use this money for your personal needs without transferring into your personal account and paying taxes? What you can use this money for?
Yeah, great question. This comes up all the time. So let's break down your scenario. 200 grand gross commission income. 50 grand on a wage brings you to 150. Another 50 grand in business deductions brings you to 100.
Yep.
Whether you leave that 100 in the S corporation account or you pull it all out to yourself personally, same tax effect. People get worried about taking that money out of there. Your tax on that net number, right? 200 minus the 50 in wages, minus the 50 expenses, 100 grand you're paying tax on. Whether you leave it in there or rip that account out to zero, same tax effect. Don't be worried about taking that money out.
But isn't there like a difference as in a way of how S Corp is getting charged for taxes, like around 20%. But if you send it to yourself, then you're paying self-employment tax.
No, so that's a C corporation.
Oh, okay.
C corporation. C corporation, same scenario. The 100 grand, you're paying 21% on that net number. If you pull it out, you're paying another 21% on what's called a dividend or distribution, putting you at 42%. C corporations do not make sense for you guys. Gotcha. Realtor should not be in a C corporation. Real estate holdings should not be in a C corporation. C corporations make sense for like $30-40 million company that don't need the money, that are going to keep reinvesting it. If you want to live on your money and pull that money out, a C corporation does not make sense. I didn't even talk about it because it doesn't make sense in your world.
Yeah, and if you don't mind, I have a second part of the question, Brendan,
sure.
that I want to ask. What's your thoughts on bonus depreciation for real estate professionals when you do investing in real estate? Because technically, if I understand it right, if let's say I made $500,000 this year, you know, I pay taxes, all of this stuff. I still can put this money, instead of paying tax, I can put this money into real estate within the end of the year. Let's say I'm buying a property in December. I use this money to buy a property. I got a mortgage for the rest of the money. Let's say it's like only 50-50. And then I can do accelerated depreciation or, you know, cost segregation within the same year when I bought the property.
Yeah, I love it. That's why the cost seg, because you're real estate professionals. So if you weren't a real estate professional and you earned over 150 grand married filing jointly, these rental losses are suspended. You don't get to use them. They're suspended until you dispose of the property. But because you're all real estate professionals, you get these rental losses. So for your situation, yeah, you buy a property, take the cost seg, take whatever accelerated depreciation's out there, you get to take those losses dollar for dollar to offset your other income. That's why I like that so much. And awesome. On that bonus depreciation that's non-cost seg, it used to be 100% of qualified leasehold improvements. This year it's 80%, next year 60%, and after next year, Trump's tax reform is bye-bye. We'll see what the new reform looks like. But, you know, thinking about buying a rental, that vehicle, hey, I need a car, I want to buy a truck, this is a good year to do it because a lot of that stuff's dropping off.
That's great. Thanks, Joe. All right, let's do, so Matt Becker, I know you had a bunch of questions too, so let's get two more real quick. So Dan, go ahead, and then we'll get to Matt Becker too.
Hello, can you hear me, Joe?
Yeah. Yep.
Okay, cool. I still a little bit confused about the LLC and the S Corp. So correct me if I'm wrong. So as my understanding, if you make from 0 to 100K per year, set up the LLC right away. And then if you make, over 100K, you switch to the S corp. Is that right?
I like the 150 number because by the time you issue wages under 150, there's not a lot of tax savings. And again, setting up that LLC early allows you to S-elect it down the line easier. No
Okay.
tax savings in the LLC, whether you open one or not. It just gives you that flexibility of S-electing it down the line. Again, you could argue that number. I like 150 because at 100, by the time you issue W-2 wages, that reasonable compensation, there's minimal tax savings.
Gotcha. And my second question is what is the best way to set up the LLC? Because I see some website offers that service. The guy who do my tax, every year I talk to him as well. And now, I have the chance to working with you guys as well.
Yeah.
And
So
how long does it usually take to get up to set up the LLC?
Yep, I have paralegals on my team. I used to ship this stuff out to attorneys. They were overcharging. They were doing it wrong. I said, forget this. I brought paralegals on my team. We can open up LLCs or S corporations in all 50 states. We can get an LLC or an S corporation opened up, ready to go, open up a business bank account in 24 hours.
Oh, man, that's great. Okay.
Joe's the man.
Well, thank you so much.
All right, let's go to Matt Becker. Thanks, Dan. Let's go to Matt, and then we'll end with Matt.
Cool.
Great questions, you guys.
I had kind of like two questions. One is, if we haven't been paying quarterly, is there any way to help with like the fees, like in mitigating that cost? Because I didn't do it last year. I know you were kind of mentioning that you may be able to get away with it one time. And if I didn't pay last year, what penalties should I expect?
Sure. Two ways. One, we can do a quarterly now, and then again in January, that'll offset some of it. The other way is if we issued you a W-2 for an S corporation, you could have some federal and state withholding come out of that. The nice thing about W-2 withholding, even though it's done at the end of the year, a W-2 spreads evenly for the whole year in 2023, so it acts as a quarterly tax payment. Okay. The penalties, they fluctuate depending on the taxpayer, but it's usually about 3 to 5% of what was underpaid in estimated tax. And sometimes that's the same amount of the tax that you owe. That's why if we know that they're strict on these, you got the money sitting over in an account, pay it, send it in. And if we were to do a tax projection, we actually prepare the vouchers, both federal and state, give you online instructions to both the IRS and to your state, so you can pay those very easily.
Cool. And what's the? I remember talking with someone on with the IRS, and they were saying it has to be just a small payment. It doesn't have to be anything significant. But do you suggest throwing the whole 20% at it just every quarter?
That's the best way to dial it in. There's different equations. You can go 90% of the current or 110% of the prior. End of the day, if you just focus on 100% of what's owed that quarter, there's no guessing games. You've covered yourself. When I say cover yourself, that means that you're penalty proof. We hate penalties, right? Like I said, we give the feds and the state enough money. Why give them penalties and interest too?
Yeah. And then my last question was, so for the solo, I'm an S Corp, for the solo 401k, can you, like, obviously you'd save on taxes today, if I were to backdoor that into a Roth, does that make more sense, or do you suggest just keeping it in the solo 401k?
If you backdoor that into a Roth, you have to, one, pay a 10% penalty because you pulled from the qualified account, and whatever you pulled to go to the back door is considered taxable income. If you're putting money into a solo or a SEP, that money really should be left alone. This is not money that you want to play with because there are penalties, and then it's taxable if you take it out.
Gotcha. Cool. Thank you, man.
Yep.
So, man, Joe, can't thank you enough. I mean, I don't know if you saw the comments. I know you were focused on your conversations. People saying this is the best tax workshop they've ever been to, ever. So I think people's biggest worry right now is how are you going to handle all of us? We're calling you the Listing Agent Academy Inner Circle CPA.
Yeah.
So we're going to do this more often. Joe and I used to do these quite a bit, but we can do this. I think, Joe, you and I talked about doing these quarterly, perhaps.
I'd love to. We got really, I was on, I think, the first quarter, second quarter, we didn't connect, but we connected now. I think maybe again, Brandon, early in 2024, when it's tax season, it's on everybody's mind. That might be a good time too.
Okay.
And then we'll know what some of these changes look like. But again, feel free to reach out. Even if you're like, hey, I got a CPA, I just want to, if you have a question, whatever you got, feel free to reach out and we can help you guys.
Awesome. Well, thank you so much. You guys, we'll post Joe's information in our Facebook group. I will talk to Joe to see if he's open to joining our Facebook group, but I just want to make sure he's good with that before I do that. And then if you guys have questions, just like Joe said, reach out to his team. They're amazing. I've been working with Joe for a long, long time. And Joe, we really appreciate your time today.
Yeah, no, thank you, Brandon. Thank you, Ben, for having me on. And like I said, feel free to reach out and talk to you guys soon.
Take care. See you guys.
See ya.